Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, everybody. Welcome to this Wednesday edition of Benzinga's Pre-Market Prep. Spencer Israel here with Dennis Dick. On our show today, we will be joined by Chris Versace, the CIO of Tematica Research. He will stop by at 8:35. But before then, we got a lot of earnings to discuss. Morgan Stanley, Texas Instruments, the earnings from yesterday. Netflix had a nice reversal, so we're going to talk about that as well. Gold can't seem to catch a bid. Bitcoin. Oh, man, it looks like we finally broke through that level. We're going to talk about that a little bit this morning. So got a lot to discuss. We'll take your questions from our chat, as always, youtube.com/BenzingaTV. You can join our chat there or premarket.benzinga.com. Looking at the S&P futures, we are off our highs of 28.16 from the overnight session. Crude and gold both trading down, continuing to trade down, and Bitcoin, like I mentioned, we hit a high of 75.60. I guess I'm going to bring the chart up right now of Bitcoin. We hit a high of 75.60 overnight. Finally broke through. It looks like we finally broke out there, Dennis. What happened? Were you in it? Was it you?
Not me. You know I'm not going to be a Bitcoin there. But you know what? It just formed a base. We talked about it a little bit on the show, and it had been basing forever around that 6,000. Bring up the chart. So, you know, all we have on Bitcoin is technicals, really. I mean, there's no cash flows to analyze. There's no valuation to analyze. All you have is technical. So if you blow the chart back just a little bit further, let's look, at all the support we formed around 6,000. So it just was putting in a base for a long, long time and finally broke out from it. So it's good news for the bulls here. I mean, at least in the short term. I'm still not going to jump on and become a believer of crypto here because we got 1,000-point rally here after a 13,000-point decline. But, it's good news for the bulls. And I still say, and just like I said about a few weeks ago when we were talking about the 6,000 level, I mean, if you're bullish, put your stop at the old low, which I think was around 5,700 or 5,800, and you run with it. So there it is. So now it's up at 7,400. So it's looking pretty good. I'm not chasing this. I'm not getting in. I'm not becoming a crypto trader. I was joking with Jeremy Newsom because we were tweeting back and forth. And Jeremy is a Bitcoin bull, and he is in Bitcoin. And we've had Jeremy on the show there before. And I was just joking back and forth. And he's like, saying that this was buying opportunity. I just joked at him, sold to you because I'm not into the crypto or whatever. But, good call, Jeremy, because and then he was saying, oh, and I'm glad you sold that to me. And we were just joking back and forth. And I just said, you know what? I better stick to equities. But, regardless, you can do a technical on anything here. And that base formed for a long time around 6,000. But I'm not going to all of a sudden jump in here and become a Bitcoin trader. Lots of good stocks to trade. And this is more of a stock show than a crypto show. We're not going to become CNBC Fast Money where we're going to cover crypto on a bullish rant for 20 minutes every single night. So let's take it back to the equities here. That's my 2 minutes of bullishness for Bitcoin there. I'd say if you're in it, stop yourself out at the old low of 57, 5,800. And maybe you ride this for a bit. Maybe it can work out. Who knows? But I'm still not a believer in the crypto overall.
All right. I don't want to get you started on a rant about that. So let's move on to the stocks. I guess we'll start with
better things for me to rant about.
Let's start with Morgan Stanley, I guess, for the day. They reported about an hour ago. Q2 EPS $1.30 versus $1.11. Estimate sales 10.6 versus 10.1 $1 billion, so beats on both the top and the bottom line for Morgan Stanley. Look, now that we're done with the major banks, we can say that with the exception of Wells Fargo, they all beat. Citi was mixed and Wells missed, but the rest of the big banks all beat on their earnings. What is the stock doing this morning?
Holy cow, I just looked at the video. They're up close and personal with me here today.
Yeah.
I better not pick my nose or do anything like that here. You've got me blown right up there, Spencer.
I got you blown right up. But now I got the chart up.
Okay, let's go look at Morgan here. Yeah, I don't want to keep looking at my ugly mugshot there. MS up $1.50 here in the pre-market. I mean, the banks have reported pretty good numbers. You were pointing out that Wells did miss and Citi was mixed, but JP Morgan was a decent report. Goldman was a good report yesterday too, but they sold it off after the initial pop. Bank of America, we know, actually held the gains, so it popped and kept and held the gains, which is good news. I mean, the banks have turned around to a certain extent, and we were hoping for a pullback there. And Goldman to buy, which actually we got, course, I didn't pull the trigger, but that's what I was talking about yesterday on the show. Got all the way down to 226. So the banks remain in favor here all of a sudden. And a lot of the value names are back in favor. And, just like we were talking there yesterday, it was a lot of names, the value names that really caught a bid yesterday, but then all of a sudden they started buying everything again. And the growth names caught a bid too. And we're going to talk about that rebound in Netflix just in a second here. But just, looking at, just Morgan Stanley here, just from a technical basis, you're breaking out over 50. So you got to hold 50 here now. If you look at May, June, that's where your bottom was around 50. Then you struggle to get back over it. We have not been over 50 cents. So it's very important that this stock holds the $50 level and gets back up over it. Otherwise, it could be one that gives it back again. So I'm known that I don't chase banks. And in every single bank case, except Bank of America, they kind of really gave you a second chance. So is this going to be one that just gaps and goes? It could potentially be that, but I'm willing to miss the trade for that because Goldman was a pretty good report yesterday too. They sold it off before they eventually did rally it towards the end of the day. But I've just learned the hard way that when I'm chasing banks, I'm usually losing money, and they usually give you another chance. So hopefully we get a pullback there, and then I would probably be a buyer. Again, the banks are back in favor though.
Knowing what happened the past few days, though, knowing how the banks were weak on Friday, they all reversed on Monday. Goldman kind of rallied into the close yesterday. Knowing that, does that color your thoughts at all as far as what Morgan could do today?
Yeah, well, that's what I was just trying to use the Goldman action. This is typically how I trade. I'm a relationship-based trader. So I look to other stocks for information about stocks that are related for information on how they might trade. So the first thing that I do is obviously look at the Goldman Sachs chart and decide, is this look like, this is going to, pull a similar, what did Goldman do on its earnings? And it popped and it dropped. And that's why I'm cautious on Morgan Stanley. If Goldman was the gap and go yesterday, it would probably be a different story, but it wasn't. So you've got to be cautious here, just chasing Morgan up. Now, if I was long, maybe you'd stick with it here. But I'm just saying, if you want to initiate along here, more often than not, I feel like it gives you a second chance. And the Goldman tape yesterday would say it would give you that second chance.
All right, let's move on to another earnings report. This is interesting because they weren't scheduled, but I want to talk about TXN Texas Instruments because they reported yesterday after the bell as part of another release where they announced that their CEO, who had been on the job since June 1st, is out due to violations of the company's code of conduct. So the release led with the news that the CEO had resigned. And then, in the last paragraph of the release, by the way, here's our earnings for the quarter. And they beat Q2 EPS $1.40 versus $1.31. Sales $4.02 versus $3.96 billion. So good numbers on the Q2 earnings. But I just thought that was interesting the way they kind of snuck it in there at the end.
Yeah, and the Texas Instruments traded down on this. It's starting to come back from the lows here. I mean, what's more interesting to me is how many new CEOs does this company want?
Well, they're on their third. They're on their third one of the year. So
third one of the year. They got to figure it out. You can't just keep firing your CEO every 5 days or whatever. Anyway, so Texas Instruments is trading down on this. Is it a buying opportunity? I don't know. Probably. It seems like everything's a buying opportunity when you buy the dip. The best strategy in the last 5 years, I said it, I think about a few months ago on the show, the best trading strategy is still that BTFD, which is buy the blank dip. I mean, that thing just keeps working. It seems like stocks pull back. And, in some certain sectors, it hasn't worked. But overall, especially on tech stocks, seems like whenever they dip, they pull back. The one buy the dip, and I was tweeting with this with Nick Shaheen yesterday, Oracle. I mean, Oracle always seems to get hit on earnings, does it not? Like, it seems like it reports, it gets slammed for like 10%, and then you look at it a month and a half later, and it's got it all back. Again, Oracle, the exact same story here. Once again, gets slammed on earnings. You can see it back in April or back in March, got hit, slowly crawls its way up. Reports disappointing numbers there again, I believe in June it was. Goes down hard, all the way down to $42. Look where it is, $48.90. It gets up to there yesterday, so and closes right under $49. Comes all the way back. So these tech stocks, just as they come back, just as they get hit, they seem to come back. Netflix, they did not wait for yesterday, Spencer. Netflix was just like, we're buying the dip right from the opening print. And that stock opened, and it never looked back. It opened, and it went up through 350. Then it went up through 360. Then it went up through 370. Then it went up through 380. By noon, we'd already gotten 2/3 of the losses back. It was incredible considering, they missed pretty big time on the numbers. And it just comes back. I mean, there's just portfolio managers, and there was 2 upgrades. How often do you see a stock get slammed for 50 points if analysts come out with 2 upgrades? So, buy the dip mentality is not only in the retail market and in the investor's mind, it's in the analyst's mind as well. And they had that Stifel analyst on CNBC yesterday talking about why he upgraded the stock. And it was simply that it was a valuation that got ahead of itself, and the 50-point decline is giving him another entry point. So he's a buy the dipper too. I mean, these buy the dip traders are just coming in on the main stocks, and it works. Google was the same thing after its earnings report last time too. Google, remember, dipped all the way down, if we go to its earnings report, down to $1,000. It went from like 1150 down to 1,000. Well, look, Google made new all-time highs yesterday. So if you were just closing your eyes on these tech stocks and buying the dip, it just continues to work. I don't know when that trade stops working. One day it will not work, but I tell you, it's worked over the last 7 years, especially on the tech stocks.
I don't want to be like hindsight capital or anything, but I mean, that Netflix trade, I think, was a little bit predictable. How bad is one quarter really? It was one quarter. It was not a great quarter. It wasn't.
I wish you had told me that yesterday, because then I would have bought it.
It wasn't.
I didn't know it was going to rally 30 points.
It wasn't the worst quarter ever.
I thought it might rally a bit. I didn't think it was going to get 2/3 of the losses back.
It wasn't the worst quarter ever. I mean, it wasn't good, but it wasn't the worst quarter ever. And look, I'm all for, what I was telling people at Benzinga yesterday is, if you weren't bearish Netflix before the earnings report, then this is not like that shouldn't have been enough to change your thesis. If you were bearish before, then fine. But if you weren't bearish before Monday, one bad quarter, I mean, should not be enough to totally.
There's just too many money managers that want to own that stock. And you know what? And why does buy the dip really work? You could say, oh, well, retail's coming in, but retail's a smaller piece of the market. You know why it really works? Is because there's so many bloody ETFs. And there's so many ETFs out there that all got to own the same stocks. And they pull back, and it's not only ETFs, it's just so many funds that are similar too. Even the funds that aren't ETFs, that there's tech funds. They buy these stocks on these pullbacks. And there's institutional money managers that just, they got the mentality that, hey, if I'm buying Netflix here at 350, well, I'm a lot better than the guy that bought it at 400 a couple days ago, so I can outperform the market. And none of them are concerned about, whether they, make money. Well, they all want to make money, but they're not concerned. They're more concerned about beating the other guy, beating the averages. That's where they benchmark to. So if the S&Ps are up 5%, they figure, oh, we'll get a pullback here to buy. Well, I'm way better than the money managers that bought Netflix over the course of the last 2 months. So why not come in here and buy it this morning? That is mentality is out there. And that's the big money. It's the institutional money manager that comes in and moves these stocks.
Not for the passive instruments.
Not the passive ones, because they're just benchmarked. But I'm just saying the active, the more, and there's, obviously a lot of ETFs that do a lot of different things, but not even ETFs. I'm just saying even the traditional funds.
Right.
I should just say the institutional money manager has the mentality of buy the dip now too, because when they're buying the dip, they're buying cheaper than everyone else. So there's been no reason, nobody's been punished really hard buying the dip in the last 7 years for the most part. I mean, we haven't had a significant pullback of over even a 20% here in the last 8 years on the S&Ps. We have on individual stocks. We have on some other indices, some other, countries too, have been into bear markets and it hasn't worked. I mean, if you were, buying the dip on the Nikkei back in, Japan in 1993, you were still waiting to get your money back, because the Nikkei topped out like, 40,000 or something back in 1993. And now it's like 20,000. I don't know where it is lately, but you're still down significantly from where it was 25 years ago. So, in this case, it doesn't always work. But I'll tell you, in this market, in this U.S. markets, it has worked nonstop for the last 7 years. So a whole breed of new institutional money managers, a whole breed of new investors have learned that every time we pull back, you buy it and you get rewarded. And until that doesn't work, until those people, get, washed out or, get hurt, that mentality is still going to be there. And the buy the dippers are still going to win. And that's what it is. And the buy the dippers continue to win in this market.
Well, let's talk about that longer time horizon, because we were talking about this briefly on the pre-market show. There hasn't really been a sustained period of weakness for obviously quite a while, and you were wondering, what is the point of really owning gold? Historically, obviously, it's a hedge, it's a store of value. That's how the logic goes.
This has always been the argument,
right?
And J.C. Peretz has shown that and some of his statistics, and he does a lot of stats over there too. That really it's not that defensive. I'll tell you, maybe long term it has been, but I'll tell you in the last year, gold has not been defensive whatsoever. When we were going down in June and the S&Ps, had a little bit of a rough spell there when we went from 279, look at the SPY, to 269. Look what gold did during that time. It went from 122, if you look at the GLD, down to 118. It went straight down. So it didn't perform defensively at all. Now the market starts rallying. What's gold do? Continues to go down. I mean, there's just people who, I don't totally get the need for gold anymore. Years ago, it was a sign, and the store of value argument, but it wasn't even a sign of store of value. It was to show value. People wore gold. People were wearing silver. People don't wear that stuff like they used to anymore. I mean, yes, there's still, rings and there's different things, but you don't see people wearing the bling bling necklaces. You don't see people, showing off. And I just don't think that gold has the luster, no pun intended, that it used to, at least in, the retail mind. So I think gold is going into a continued secular decline here. And I think every rally in gold needs to be sold. If you want to ask how many gold stocks I own in my portfolio, I think it's one. I think I own Gold Corp. And it's been a bad one. And, any gold stock in your portfolio has really been bad. But gold and precious metals is less than 1% of my overall portfolio. And I wish it was zero. And at the end of the year, I might just take that loss on Gold Corp and I might just have it at absolute zero. And my money manager, institutional money manager say, you're running, your own money here. You don't have anything invested in gold. That seems crazy because you need it for defense. Even Kramer says it. Oh, you need gold for defense. Well, you know what? It's not playing very defensive anymore. I don't see a reason to even own gold. It's going to have rallies. I think those rallies are to be sold. And that's my opinion here. But if you look at gold, the performance over the last 7-8 years, there we are at GLD at 180 back in 2011. Now we're 116. I think eventually we go back under $100 in GLD. That's my longer term price look. I don't know when that's going to happen, but I think it's going under $100, and I think silver could go under $10 eventually. So I don't like the precious metals whatsoever.
I won't,
not as a long term investment or as a short term trade even, and because they're breaking down still. So sold to you, gold, silver.
I won't agree with you until we have a sustained correction in the equities market, and then we'll really see. Because
we'll see. You're right. Maybe if we pull down 20-30%, maybe all of a sudden that defense, gold comes in, everybody's got to jump into it. But I don't know. I just don't think it's playing defense like it used to. I can remember, trading, and I've been in relationship-based trading for 20 years. And I can remember 5, 7, 10 years ago when the markets would go into turmoil, gold would be just flying. And we just aren't seeing it. I guess the markets haven't been in turmoil, though. So you make a good point. We've had declines. We've had moments that feels like we could go
like
into
a couple weeks, like a week or two here and there.
But even during those moments, it doesn't respond. I mean, the best example was just what I just gave. I mean, it was pretty ugly there, especially on some of the tech stocks there back in June. We declined fairly significantly, fairly quickly. I mean, that one day, we watched Facebook fall $10, and we watched Apple fall down to 180 from like 195. I mean, these were declines, fairly significant declines of over 10%. Gold should have been trading at least flat during that period, if not up, and it traded down. So if you're making the argument that I'm going to have gold just because if the market starts to go down, my gold's going to go up, it's not working. So I don't know. At least not in the short term, it's not working. So I don't see a reason to have gold in your portfolio. I know people say it's defense, and most money managers will have it. I don't see the reason for it.
All right, let's go back.
Peter Schiff will hate me for that.
Yeah. Let's not go there. All right. Let's go back to the earnings.
Peter's just never coming on the show again after I just said that.
I don't think he was coming on ever again
from
the last time we had him on.
What happened last time? What was it? Oh, it was he thought it was video and it was it was radio. That was before we had video.
Right.
And he wasn't pleased with you, Spencer. He was kind of nasty.
He was mad at me. All right. Let's go to the UAL earnings yesterday after the bell. Q2 EPS $3.23 versus $3.05 estimate. So a nice beat there. Sales 10.78 versus $10.7 billion. They are also raising their fiscal year outlook. The EPS was raised by a quarter, $7 to $7.25 on the low end of the range. So a raised fiscal year EPS guidance and a beat on the Q2 numbers for United Airlines.
these are good numbers, and the airlines are flying here this morning. Full disclosure, I'm short some UAL, but I'm long Alaska, and I wasn't long American, and I was long LUV against it. I have lightened up I've sold my American. I've sold my LUV actually because they got a pretty good pop there. Still short some UAL, still long Alaska against it. So these are full flat out pair trades is what these are. But UAL with a nice pop here. It's good numbers. I mean, these are good numbers on stocks that have been beaten up. So there's, a pretty good reason here why they're trading up this morning. If you're looking at the UAL, it's actually been one of the better performers. I mean, UAL has taken off. If we're just looking at the charts from really, at the lows back in October 2017, we got down $56. Now we're trading over 75. So now as you get up into the upper 70s, you start to say, hey, and this has kind of had its rally already. The buy, the opportunity probably to go in this long term was back at the end of 2017. It's had a pretty good run. But you look at a chart like LUV, completely different story. It really hasn't participated nearly as well as UAL. It's off from $65 at the beginning of the year, down to 53. Starting to show a little bit of life here. I mean, it put in a hard bottom at 50. There's some room in some of these things. American Airlines has been an absolute disaster. So not surprising, that it gets a little sympathy lift here too. So all the airlines lifting. It's nice numbers for UAL. Question to you, Spencer, is when is the next report due? So when is the next airline due to report? And I'm throwing you right under the bus.
No, it's okay. There's a few next week. We have Southwest is the 26th before the bell. American is also the 26th before the bell. What are the big ones am I missing?
Well, you got Delta already.
Right,
I know we got Delta there.
JetBlue. I guess I'll go JetBlue. That's the 24th. That's the 24th.
American,
the 24th before the bell. So JetBlue is the 24th. Southwest and American on the 26th. So we got 3 next week. I'll look at Save while we're at it. Spirit Airlines is also the 26th before the bell. So they're all really next week.
Jump over just to the other earnings trade from last night is Abbott Labs, and it's getting a nice lift here. ABT trading up significantly in the pre-market at $64. Give us the numbers here, ABT.
ABT reported this morning, like you said, Q2 EPS 73 cents is a 2-cent beat on the estimate. Sales 7.76 versus $7.72 billion. So a slight beat on that. A slight beat on both for the Q2 numbers. Again, raising fiscal year guidance. The fiscal year EPS outlook was raised by 5 cents on the low end of the range, $2.80 to $2.85. The Q3 EPS guidance is in line. So a slight beat on the Q2 numbers, an in-line Q3 EPS number, and a raise on the fiscal year EPS number.
I got to go look at the book. And then sometimes tells you something on Abbott Labs. Let's take a look at the book and see if we see anything that's going to hold us down. Full disclosure, I own Abbott Labs, my investment portfolio. I've had it in there for the better part of a decade, so I'm sticking with it. It's been an absolute monster for my portfolio. $65 is 37,000 shares to sell there. I see another 17 at 64. Those are small numbers considering the volume it's trading, so it can continue higher. Can you go to my Twitter account? I posted a pic last night. And just, we can do a quick little 1-minute market structure segment here or there because it's interesting. I saw there was somebody that wanted to buy the stock last night, and they were stepping up with the bid after hours, and they were trying to buy like 7,500 shares. And if you actually look, I've got the trade that actually goes down. If you can show that on the screen, Spencer. I'm really throwing you under the bus.
No, I'm pulling up right now. It's okay.
Yeah. So what happens is it's like bid 63, 63.05, 63.10. There's like 100 shares offered at 63.20. And it goes to 63.20, and the off-exchange market maker sells them all. They sell all 7,500 shares at 63.20. I was like, holy cow, is that aggressive? Ahead of an earnings report. I mean, these market makers are making big bucks, but you can see there's 7,600 shares trades on FINRA. So I know what that trade was because I watched the order step up in the book. And so then they throw it. It's obviously a trader that's got access. It's that can obviously access off exchange market makers. They go to 63.20 trying to lift the offer, and there was only 100 shares offered there, and they sell all 7,600 shares on that offer at 63.20. Well, that market maker is thrown away. $7,600 here so far today because the stock's at 64.20 here right now. I mean, it might come back in for them, but that's a program that's probably not even program. Like some of these off-exchange market makers are pretty good. I mean, the Citadels are, those guys are just, monster. They know what they're doing. I think there's a lot of these off-exchange market makers making systems that aren't as sophisticated though. And some of these like literally just sell no matter what. And, maybe that's the case, but I'll tell you, if I was an off-exchange market maker, and if any off-exchange market makers are listening to this broadcast, I would probably program in not to do the earnings stocks the night before. So I'd probably pull those from my system. Be a pretty easy algorithm to pull. Pull that out so that you're not selling, 67 or 7,600 shares of a stock up 30 cents, on a night before it reports, because often the ones that are bidding it up afterwards probably, sometimes there's dirty money out there that knows what's going on too. So this on-exchange market maker getting hit here because they probably didn't have the algorithm program to consider that its earnings are reporting tomorrow morning. So we're not going to be able to get out this at the open at a similar price. The strategy would be, if it's not, and somebody wants to pay up 40 cents for a stock, more often than not, you're going to be okay, because the stock's probably not going to open up 40 cents, if there's no news. But when it's going to an earnings report, I think it could go 3, 4, 5% in your face. So pretty aggressive market making system. Maybe they're a huge trader. Maybe 7,600 shares is nothing for them to swallow. So there's that consideration too. But I don't know. I don't like to sell 7,600 shares of a stock that somebody else is bidding up after hours going into an earnings report, because that sounds like a way to lose money.
If somebody wanted to learn a little bit, kind of the fundamentals of market structure, what would you recommend they read? Would you recommend reading Dark Pools, or is there another? Is there
wow, good. Dark Pools was good. And I know Scott Patterson there who wrote, and actually, if you Google me, Scott Patterson, when he was with WSJ there, he quoted me quite a few times. I'd spoken to Scott on the phone quite a few times. I don't think I got mentioned in that book.
So we shouldn't read it. Shouldn't forget it.
Yeah, I don't think I mentioned in that book. So yeah, no. But you know what? It was good. It's a good synopsis. There's some good ones stuff. Chaim Bodex wrote some stuff. Joe Saluzzi, if you listen, Joe, he wrote Broken Markets. That's got a lot of good, interesting market structure information in it as well. The tough thing is you just grab these market structure books, and if you don't have, a background in it, you're going to read them and you'll be like, oh, I don't understand any of this. And you're going to put the book down after you're reading a page.
Then maybe Flash Boys is the way to go, because Michael Lewis, that's kind of...
Maybe. Flash Boys was wrong on a lot of things. And Michael Lewis is not a trader. So he's trying to report on something that he doesn't totally understand. So there was a lot of mistakes made in Flash Boys, like incorrect information. The first chapter was awesome. Like when they were talking about Flash Boys, when they're talking about, digging, the line in from Chicago to New York. And the mechanics behind that, buying the real estate to get this line put in that costs so much money to build, just to shave off 7 or 8 milliseconds. It's incredible, what those milliseconds mean. When you're talking about high frequency trading. To a retail trader, to me, even I don't operate on a microsecond scale, so it doesn't matter to me. But that means a lot. So that's an interesting chapter too. So, if you want to pick up any of these, just remember, it's difficult. I've written a lot of market structure content out there. I wrote for CFA magazine for a number of years. I still am actually officially a writer for CFA magazine, but I just don't have the time. And every once in a while, the editor over there gives me a ring and says, "You want to write something?" I was like, I don't know when I have the time to write anything. And that's, why, I don't produce much more education than on the pre-market show, because I got 2 young kids. I'm trading 50 hours a week, and I just don't have the time right now in my life to do writing. So, but I've written a lot of stuff in CFA magazine on market structure. And actually, I can send the link in the chat too. If you go to our own, me and Joel's site, PreMarketPrep.com, if you go under education, you'll actually see a whole bunch of stuff that I wrote, but I haven't written anything in the last couple of years, simply because since I've had kids, I don't have the time to do it.
Yeah.
I will start writing here again, but it's been a while. So I think the best stuff, there's probably stuff that I wrote, because I feel like I understand market structure, not only because, I'm kind of a geek, but because I'm, trying to take advantage of the market structure to make money. So, I look at, different inefficiencies that are created from market structure and try to extract, whatever alpha I can from those inefficiencies. So, it's incorporated into my own trading. But, overall, I get this question all the time. Is the market rigged? Sure it is. It's always been rigged. It's always been rigged, on every different level. I mean, to analysts, to everything.
But that doesn't mean
it's always been rigged to a certain extent.
It doesn't mean you can't take advantage of it.
No, absolutely not. You can't just look at it and say it's a rigged game. I can't win the game. Well, I wouldn't be in, the business for 19 years if I couldn't beat the game. So it's always been rigged. I mean, there's certain things that, and I've talked about the off-exchange stuff, a lot. And the off-exchange market making, I think, is, really, I think, that's probably where I would really dig the hardest and say, if I really had to, look at market structure and say, this is what I want changed. I think, the person who's offering the stock should actually get filled when somebody else wants to buy it. I don't know why we need to have an off-exchange market maker step in the middle at the last second to, basically, take the fill away from the limit order trader. So really, in this market, if I was to give you a 1-minute summary, the limit order trader, the person who's putting their bids and offers out there, is very disadvantaged, especially on smaller cap stocks. You don't notice on the big caps because they're trading like crazy and you're probably going to get filled on your price if you throw it out there. But on the small caps, you throw out a bid and your penny jumped. And not only that, people will trade at your price. So there's literally, you'll be the only person in the whole world bidding for the stock at $22. Somebody will try to sell it to you at $22. Off-exchange market maker will jump in front of you and it'll print on FINRA at your price. It'll print there again and again and again, because the off-exchange market maker is jumping in the middle to take away your fill. That happens all the time. All the time, you probably should get filled on certain stocks, and you don't get filled because of the market system, and that's not fair. I think the person who is bidding the stock, who's the only person out there, and somebody wants to sell it to them, should get filled. And that's, been my argument the whole time. I've written a lot of papers about this through CFA Institute. I've written papers on this through Bright Trading, and I've written a lot of material on it in CFA Magazine, is that I think the limit order trader is very disadvantaged, and I think that's what they need to start to focus on, but they never do. So, that's the bottom line. So what do? I don't really put limits as much out there. You have to put limits, but I'm more a taker of liquidity. I don't like to just sit my order out there and wait for the price to come to me. When the price comes down to where I want it to be, then I take the offer. Or I use discretionary orders, where if I want to buy the stock at $22, I'll throw it down at $21.50 with 50 cents of discretion. So when it comes offer at 22, and that order is already on the exchange, it instantaneously lifts the offer. So then I don't have to worry about somebody penny jumping me or leaning on my bid for protection, because my bid is way out of the market. So that's how I've adjusted my trading for the current environment. I don't just set my limit waiting, to get hit. I put it way out of the market and then use a more liquidity taking order to get filled. And that's, how I try to, not be disadvantaged by the limit orders, being basically used and free rode off all over the place.
All right, 8:33, 2 minutes before we're going to grab our guest for the day, Chris Versace. Let's grab some imbalances before we do that.
I haven't looked at them yet, so they're hot off the press. They're mostly sells. So you are seeing the market starting to turn a little bit weaker. They're not huge, but they are to the sell side there. Bank of America, 34,000 or 54,000 to sell. It's trading slightly higher on the Morgan number there. You know what? They're so small, though, too. Oh, Berkshire Hathaway. We've got to talk about this one. 32,000 to buy. Berk.B. Let's go into this one because Warren Buffett last night, if you look at Berkshire Hathaway, what's going on with Warren Buffett here this morning? Berk's catching a nice bid because they changed a policy last night that will allow them to buy back their stock at any time. So the old policy was if Berkshire Hathaway, Berk.B, was trading 20% above book value, they could not buy back the stock. That policy is now gone. They can buy back the stock at any time. So I think everybody's anticipating, Warren's going to do a big buyback on his own stock.
But they didn't say he was going to do that.
They didn't say it. So everybody in the market is treating it like he's doing a buyback is imminent because it's trading up $4.50 here right now. But it was only a policy change. So market is reading a lot into this policy change. I don't know if a buyback is imminent. I don't know if it's coming here right away. But Berkshire typically does trade with a premium over book value. Why is that? Because everybody wants to invest with Warren Buffett. So, the assets are worth so much. Usually Berkshire.B and Berkshire.A will trade significantly above that because Warren Buffett is, been possibly the best investor, that the markets have ever seen. So people want to invest with him. That's why he trades with the premium. He can buy back his stock at any time. That's the news story here. It's not an official buyback, though, but the market is reading into it that he might be going to be buying back his stock.
All right, 8:34. We're going to take our only break of the day. We're going to grab our guest, Chris Versace of Tematica Research, and we'll be right back in a moment with Chris. All right, welcome back, everyone. Pre-market prep. Spencer Israel, Dennis Dick, now joined by Chris Versace. He is the CIO of Tematica Research. He is the co-author of the book Cocktail Investing. He's the co-host of the Cocktail Investing podcast. And last I checked, he is a professor at NJCU School of Business. Chris, how's it going this morning?
It's going great. I got to tell you, I'm just back from a week off, and that intro reminded me how tired I usually get.
Okay, so here's a question that I like to ask people who have, and we asked this to Dennis when he goes on vacation. When you take a week off in the markets, first of all, how off are you really? Are you like totally disconnected, or are you still looking at the markets?
So it's a great question. Usually, I have my iPhone in my pocket and I'm checking messages and all this other stuff, but it's been a long slug. So I actually did, if you can believe this, 10 days without looking at the market.
Is that like a personal record or something?
That's probably the second longest time I've ever done it. The longest time was going back probably 98 when I think I took 2 weeks off.
Okay, so 10 days off the market. How are you getting back into the swing of things?
Painfully. and I say that because it's like drinking from the fire hose. There is so much that happens. However, let's remember that I started right after the 4th of July, which was a quiet week. So it really wasn't so bad. And the fire hydrant, if you will, of earnings really kicks off. We've had some reports last week, this week, but it really kicks off tomorrow. So I'm hoping, fingers crossed, that my timing was pretty good. And let's be honest, the big driver of last week, other than bank earnings, was probably the back and forth on trade, and we're just going to see how that develops.
All right, let's talk about some of the stocks on your radar. We were talking about
Sure.
Netflix earlier. They reported obviously on Monday. They had a nice reversal yesterday. I was saying that one bad quarter does not turn a thesis, a bull thesis bearish. But what are your thoughts on Netflix?
Well, I agree with you. I mean, I think going into the report, expectations were rather high. You guys look at the charts probably better than anybody. Your stock was up over 100% going into that report. So we would say on a fundamental basis, it was priced to perfection. They had to deliver everything and more. Did they? No. But having said that, when so were the misses, the revenue line, the EPS line. Sorry, EPS was a beat and subscribers were a little bit of a miss. Revenue explained a little bit away by the expansion overseas in currency. To me, I think the subscriber numbers were probably getting a little bit ahead of themselves, even though I understand the company used that forecast. The bottom line is subscribers were up 26% year over year. That's still a huge number. And we know the content spend is going to be heavy in the back half of the year. I still continue to feel good about it. And here's the thing. When you look at it on a valuation perspective compared to, say, Amazon, Facebook, or some others, on a PEG basis, if you can get comfortable with that 460-ish number for 2019, it is as cheap as can be, clocking in around 0.4 on a PEG. So I think there's a lot more room to run. And I think people were waking up to that. That is why the shares, as you pointed out, sold off hard 14%, but they only closed down 5% yesterday.
Mm-hmm. And sticking with the FANG theme, let's go to Amazon. They reported over $1 billion in sales for Prime Day. That won't be the final number, but at least we know it'll be in the billions. Thoughts here on Amazon and where they're at right now?
Yeah, so I came into 2018 saying Amazon was my number one pick. Okay. Oh. And I have ratcheted my price target from $1,750 to $1,900. And that was even before the PillPack acquisition. So I think, going into the back half of the year, it's seasonally strong for Amazon. I think Prime Day, if they can hit that 3.4 billion number, great. There's some concern about that because of the outage that they had.
Right.
But having said that, though, there is so much more disruption to be had by them in the back half of the year. And when you think about the secret of Amazon, okay, it's twofold. One, you have the cash flow generation, earnings generation from Amazon Web Services. Walmart, its retail competitors don't have that. But the second thing is they are pros at removing friction. And I think they're going to figure this healthcare thing out. And to me, that is just a turbocharge to the revenue and profits that they're going to get. So to me, I just think it's a win-win. The international expansion is good as well. My $1,900 price target is under review, candidly, with an upward bias.
when Amazon has an outage and they need to go to their servers and increase their server size, do they just pay themselves? I mean,
that's actually, in this case, I think they kind of ding themselves is kind of what it is. But it's a great question, but I'm glad you bring up that point though, because there are certain companies out there. Amazon is certainly one. Costco is another one where people tend to look at this in the retail box, but the business model, when you really look at where they generate their profits, is very different, right? Costco, it's about expansion of the warehouse and membership income. That's really one of the big drivers of their operating profit and EPS. Amazon, same thing, just Amazon Web Services. And we continue to see companies moving to the cloud. And remember, folks, there is a big Pentagon contract looming in the back half of the year.
You've got a couple of ETFs that are on your radar. Why don't you kind of run through those and tell us why you're watching what you're watching?
At the risk of being rude, since I'm still a little sleepy and jet laggy, could you remind me what those ETFs are?
You said you're watching Dog, you're watching Diamonds, you're watching.
Oh, okay. So you're picking up the tweet. Got it.
Yes.
Okay. So here's the setup for why I'm looking at those. Expectations going into the back half of the year for S&P 500 earnings are up more than 20%. Yet, when you take a look at the what we're likely to hear all about this earnings season, we've got trade, we've got tariffs. We saw what Harley-Davidson had to say, and I think we're going to see more of that. Not across the board, but more of that. We've got a dollar that's on the rise. That's a natural headwind, and the economic data that we're seeing, at least outside the U.S., is suboptimal, pointing towards slower global growth. And this morning, I think we saw, despite the nice retail sales number that's good for restaurants, drugstores, and other things on Monday, this morning we saw a housing starts number that was way below expectations. So you kind of put it all together, and I think that you're going to see companies issue somewhat more conservative than expected guidance. And if we get that, that means that earnings expectations will be recalculated for the back half of the year. It means people will be rethinking the market multiple. So when it comes to SH and Dog in particular, it's always nice to have a little protection heading into earnings season, because odds are this earnings season is going to set the tone for the back half of the year, and it could be a little less than people are expecting. Remember, 2017 was a year of a continued melt up. 2018, really, as we exited January, the market started to become very different than what people were expecting, and I think we're going to see more of that at least through the summer.
Another stock on your radar is Habit Restaurants, HABT.
Oh, yeah.
I haven't heard that name in a few months or a few quarters. Why are you watching this one?
Well, two things. One, about 4 miles from me, one of the first East Coast ones opened up, and I happened to eat at it, and I loved it. So if you want to follow Peter Lynch, buy what you like. But the other thing is that we understand the story on restaurant stocks. It's all about the geographic expansion. And we can trace this back. Starbucks is a great example. Shake Shack's another example. Habit is really now starting to go in expansion mode outside of California. They've got, like I mentioned, one location in Northern Virginia, a couple in New Jersey, and they are on that expansion path. So to me, that's always the secret sauce. Starbucks, you would argue, they're saturated. Dunkin' Donuts, perhaps, but although that too was another great expansion story when it went from east to west, Habit's going west to east. So I just think it's a good, natural small cap name that's expanding and doing all the right things.
You're in Jersey. Are you excited about the legalized sports betting?
I will be in New Jersey in 2 weeks to discuss the New Jersey NJCU 50 index that I created, which is a barometer of the New Jersey economy, something a little different than I usually do, but still kind of fascinating. Will I be excited about that? I don't know that I'll be swinging into Atlantic City to check it out. However, I do think for companies like MGM Resorts and some others, it is a positive. Although I got to be honest, MGM filing that suit against shooting victims, I don't understand what that's about.
Yeah, but it's about the bottom line. Tell us a little bit about the cocktail investing and kind of what you guys do there.
Sure. So, Cocktail Investing is the podcast that I do with my co-host, Lenore Hawkins. She was also my co-author on the book Cocktail Investing, Distilling Everyday Noise for Clear Investing Signals. And that title of the book is really kind of the mantra for the podcast. We try to do just that, based on the geopolitical front, the economic data, or the thematic signals that we're finding. We try to put some context and perspective around the market. We also do some interviews, kind of like you guys are doing to me. We've had people like great conversation, very insightful. We posted last week was with Sal Gilberti of Tucrium. They're a commodity trading firm, and they are the brains behind several ETFs like CORN, WHT, and SOYB, so corn, wheat, and soybeans. And it's in those conversations which echo what I did as my time as a sell-side analyst, when you would meet with management teams and kind of get the, not behind the scenes or inside scoop, but you would get some granularity on what was going on in the industries and businesses. And it's those conversations that we love. We love to share those, hence the podcast. But here's the deal, guys. According to Sal, you're seeing the ag commodities current pricing below the cost of production, unsustainable. And Sal also did a good point reminding us that, China, 20% of the population, 11% of arable land, they will be back importing in bulk before too long. So whether it's directly or indirectly, they'll be doing it from the U.S. because we are one of the number one producers of those commodities. Odds are high that those prices will rebound. So, just a little different, kind of off the beaten path for me on ag commodities. Having said that, though, your listeners might want to check those particular ETFs out as well.
Anything before I let you go? Any kind of last words for today, or for the rest of the earnings season, or the rest of the year, or sort of where your head's at in the market right now?
So the one thing I would say, coming into 2018, I think a lot of people, because of tax cuts and the thought of an accelerating economy and what it would do, we're very bullish on the revenue line and the EPS line. And I think what we saw coming out of the March quarter and really in the second quarter, as we've heard more about inflation, the word of wisdom, if you will, is watch the cost structure. Okay, look at the input costs, figure out what the impact of that will be on the operating margin line, operating profit line, and think about that impact for EPS in the back half of the year. I think that if there's one area other than trade that might be a little bit of a hiccup, I think that could be it.
All right, Chris Versace has been on with us. He is the CIO at Tematica Research, co-author and co-host of the Cocktail Investing and the Cocktail Investing podcast. Chris, great as always. Thanks so much for the time, and have good luck out there. Have a good one.
Happy trading, fellas.
All right. 8:48 now in the markets. Where are we at on the S&Ps? Dennis, anything interesting going on?
Just kind of meandering. We went down a couple points. It's a very quiet morning here. So if you're looking for volatility, this is not the morning here for it. Call it, the calm before the storm, if you will, because we are going to get some big earnings here coming up tonight and tomorrow night. Tonight, we're going to see IBM, eBay, American Express. And then tomorrow, I believe we get Microsoft, which is going to be a big one as well. So you've got some big earnings coming up this week. GE, we're going to hear from Friday, I believe, as well. So it's going to be a big week for earnings here coming up. But yeah, it's quiet out there right now. Really, if I'm looking for trends here this morning, financials are looking strong. Morgan Stanley continues to hold the gains. Goldman Sachs is up another 87 cents here this morning. So banks continue to maybe lead the way here. If I'm looking for weakness, there is some weakness in oil stocks here this morning. Again, if you want to see anything that's been weak here the last few days, because the market's been really strong overall, it's been oil. Oil, did try to bounce back a little bit yesterday, but overall it's been very weak there. You look at stocks like Chevron and Exxon, they're starting to roll over here again. I'd be very concerned ExxonMobil if it takes out the 82 support. I know we hit it towards it yesterday, but we put in 3 lows right in the same area. The last 3 days, lows 82, 82.04, and then day before that, well, I guess the day before that was 82.56, but if you go back 4 days before that, 82.02. I can't talk here now. So $82. Very key support for ExxonMobil. Takes that out, you could break down in a hurry there. So keep an eye on that one. Wanted to address a question from our chat.
Yeah, we have neglected our chat today, so I do apologize for that.
Let's go to the chat for a little bit. If you got something else, let us know here. Yeah. We're going to get to a few of the stocks here too. First, Scott was asking me a question. He wanted to know about gaps, and we talk a lot about gaps on the show. And, sometimes we just got to stop and re-explain them because we get new listeners that might not be familiar with the term. When we talk about gaps, at least, in pertaining to how Joel and I, we're looking at a spot in the chart where the stock has not traded there or a gap through it because of an event. So yesterday, for instance, Netflix created a gap. And what it did was, and it was looking like it was going to be a really big gap. The gap is now smaller. If you take the low from the day before, it was for $391.75. Then you look at the high from yesterday, 385. So you have a small gap in the chart. I actually have only 6 points. It looked like it was going to be like a 30-point gap, but it rallied so much that it almost closed the gap that day. But there's other instances, where a stock gaps down on big volume and, it does not close the gap. And, these are usually from earnings or from another event as well. So basically, if you're looking at the gap, what happens is, stock goes into a gap area. And then, you look at it, you say, if it starts to come back into that area, because it didn't trade in that area, really in the recent future, because it's a space in the charts, we say that gaps tend to fill. So if you're, subscribing to the theory that the gap is going to fill in Netflix, you would say it could rally all the way up to 391 with relative ease. That's, the theory behind it. Now, it doesn't always work, and the theory obviously is a lot different than actual trading, but gaps do tend to fill. So when we look at a stock, and, maybe Netflix wasn't the best setup, but, something else, that gaps down and then starts to come back up through that area, means it can go through there a little bit with more ease because it hasn't traded there before. We always say price is memory. And if it hasn't traded in that area, at least, in the recent, in the recent history, it can move through that a little bit more easy because nobody else is in or out from those prices. So that's gaps.
Another question going back to our market structure conversation. This is from the YouTube chat. Do you have an opinion on CFDs, which are of course illegal, in the U.S.? But do you have an opinion when it comes to those and kind of how trading those?
What is it? What is the question?
CFDs, contract for difference? No.
No, and that's I don't know what that is. CFDs.
Okay. Never mind.
That's beyond that's above my pay grade. There, if you're getting, is that what? That's not with equities, is it?
It's like a way to trade that equities. It's a way to trade a lot of stuff. But all right.
So there's a term that I have to go and do some homework on there. I know I don't know the last time I've been stumped on the show here, with CFD. So I have to just Google what that even is. So CFD trading, contract for difference, a popular form of derivative trading. Okay, CFD trading enables you to speculate on the rising and fall. So I don't know much about CFDs, so I'd have to come back to you on that one.
All right. I apologize if we missed your questions in the chat, but if you want to repeat it, go ahead because there's
a European product.
Yeah,
that's why I don't know anything about it because I only trade the U.S. markets. So Chris, all over it in the chat. Thank you, Chris. So thanks for the save. CFD is a European product, so like an equity swap. So not in the U.S. It doesn't appear to be. So that's why I don't know anything about it.
All right, there was a stock in the chat that someone asked about and I can't seem to find. So I apologize. Let's go to. Let's go to
let's go to HUYA and IQ and SOGO. We talk about these. I like to talk about these almost every day because there's a lot of our traders in the chat like to trade these things. And HUYA has just been consolidating here under $40. Tried to sneak its head above it there yesterday, but it's starting to look like it wants to go here again. And like I said yesterday on the show at the open, I said these things are buys. I think they're buys on pullbacks. We got a pullback in all of them yesterday at the open. SOG opened right at the low and went straight up. IQ had, the acquisition you talked about, but basically opened right near the low and went straight up. HUYA, it's run a little bit farther, but again, it opened at the low. It ran from 37 to 40 in the first half an hour. So these things, continue to show life here, and they continue to show that buy the dip mentality there. So I'm going to go with that until, it's not working anymore. So I'm still buy or pullbacks on all those. The one exception is BILI. I'm not sure why it's not participating. We asked Nick Shaheen about this yesterday, and it's concerning. So I don't know if I'm jumping into this one saying this is the laggard and it's going to start participating. Maybe that's going to be the case, but for some reason, BILI is not getting the love that the IQ, the HUYA, and the SOGO have before. And, there's some other ones that trade with these too, but in our own chat, PreMarket.Benzinga.com, we've been trading kind of these things together. And BILI has not been participating. So that's concerning if you're in BILI.
The question from, and now the tickers are pouring in, so let's go with it. This is one that we don't typically look at. UGAZ, I believe that's a leveraged, is that an inverse ETF?
Yeah, it's not inverse natural gas ETF.
Yeah.
These things I don't like trade. You can trade them. Again, all I'm going to say is don't put these in your long-term investment portfolio. First of all, I don't like betting, and this is actually I think this is the actual long one. So it's not the inverse.
This is not inverse.
This is the long one. The other one is whatever it is. I don't trade the triple leverage products because if I wanted to buy 3 times, I would just buy 3 times as much stock. And the other thing is, if you're sticking these in your long-term investment portfolio, everybody believes that, if natural gas is up 10%, the U-gas is going to be up 30% at the end of the year. That's not the way it works. They are day trading vehicles only. These things lag over the longer term. The best example is what we were talking about with the triple long financials, looking at that versus the XLF, and the XLF has outperformed it over the course of the last 3 years, and the XLF is not even levered at all. So it's just they lag in the long term. They're day trading vehicles, and that is it. If you want to day trade them, go for it. But if you're sticking these in your long-term investment portfolio and thinking you're going to make 3 times, if natural gas up 10%, you're going to make 30%. That's not the way it works. You need to reread the prospectus. These are day trading vehicles.
Going down the chat now, let's go to Twitter. Caught in downgrade this morning from Macquarie to neutral, but they raised their price target to $42. So I think they're just playing catch up on the price target.
It's not a serious downgrade. So, and that's what you got to look. When you look at these analysts, you can't just say a downgrade's a downgrade. You kind of got to look the color behind it. Lobster does a great job in the chat, coloring it. You often post the analyst reports when we start talking about them on the show. I mean, you got to look at it and say, yeah, this is a catch-up trade. So it's not real serious. It's not like they're saying downgrade Twitter to sell. Downgrade Twitter to sell, that spooks people, and the stock could be down $1 or $2. We saw it the other day. I forget, who was it that downgrade Twitter to sell about a week and a half ago? Or they initiated, was it Namura? Who was it?
I can look in the pro. Let's see.
Somebody like about a week and a half ago, or last week, it was Twitter.
We had, good memory. Nomura on the 11th initiated Twitter at a reduce.
Yeah, which is equivalent of a sell.
Right.
And the stock did go down that day, but then turned around and caught a bit. I mean, Twitter's loved right now. If you want to look at buy the dips, Twitter keeps getting, until it comes out, and if earnings come out and they're disappointing or there's a fundamental catalyst to change the story, right now Twitter is in favor. That's really what stock, trading in the short term is all about. Identifying what is in favor and what is not in favor. Now, a fundamental, earnings event or a guidance or something from the company can always change if it's in favor or not favor. But other things being equal, if there's no news and the stock is in favor, will tend to outperform the market. So if you can identify which stocks are in favor and, and look at your earnings calendar and know when Twitter's coming, because if Twitter's reporting tomorrow, you're going to have a fundamental reason coming in there, and you may not want to just be trading it because it's in favor, because that can change in a hurry, if they disappoint. But stocks that are in favor tend to outperform the market. Right now, Twitter is just in favor. I mean, it really didn't sell off that hard, even when a negative analyst commentary. It gets a downgrade today. It's barely down here. I mean, this is just, other reasons why, the stock is, showing you that it's still in favor here. So I think, pullbacks on Twitter probably get bought here still. I do not have this, and I will trade anything, and I might be buying, pullbacks as a trade. I don't have my long-term investment portfolio because the valuation issue for me, it just doesn't fit in. But I'll tell you, as long as Twitter stays above $42, it's a long consolidation period here. I think eventually this thing sees $50. So unless the fundamental, a catalyst, change, that thesis, I think Twitter's path of least resistance is actually still higher.
All right. Someone in the chat asking about GoGo. They had a downgrade yesterday from William Blair to neutral. Thoughts on GOGO?
Talk about stocks that are out of favor. Here is a stock that is absolutely hated by the market, maybe for good reason. I don't know. This is isn't this the airline internet GoGo?
Yep.
Yeah, so I don't know. Maybe airlines have come up with their own internet. I'm not sure, but I know when I go on a plane, it's the GoGo internet I hook up to. Anyways, it sounded like it was going to be a cool business model, but that didn't work out for them. And really since July of 2014, when this thing topped out $35, this has been a disaster. And here they are. They were trying to do something the other day, 3 days ago, and they were, I forget what it was, strategic alternatives. And the stock popped from 480 up to 525, 530. What happened that when the real money came in, they sold the hell out of it. So when the real money came in at 930 on that day that they did the strategic options, they sold it straight down. And it's still going straight down. So if you're coming in here and buying it, you're buying a stock that's completely out of favor. Can I have little intermittent short squeezes still? But I think this path of release resistance is down. Trend is absolutely not your friend if you were long this thing. It's a lottery ticket here now, $3.77. But I'll tell you, stocks go from $35 to $3. Usually go lower when you look at them a year later. And I wouldn't be surprised if this thing is $2 or $1 a year from now.
All right, let's do one more. Someone asked about ASML. They had earnings this morning. Their net income came in higher than the estimate. Their sales came in higher than the estimate as well. The currency is in euros, but both are higher. That's all you need to really know.
ADR is the one thing you need to know too, is when you come in here at 9 o'clock in the morning, they've already been trading actively. The principal has already been trading actively overseas. So it has a tight market. This is already priced in. The real money has already come in. That's what you always need to know on the ADRs, typically, especially the ones over in Europe. So the ones they've already traded on this information. They've been trading on this information. Is that where ASML is from?
Yep.
I just want to verify. Yeah, so it's already been trading actively over in the primary market here. So it's already priced in. So it's up $8 here. It's not like, oh, we're at 9:30, what's going to happen? We've already had our open in Europe. It's just following our price over here in America is just following what's happening overseas. So that's typically on your ADRs. Some of them don't actually, trade as actively. It's funny, some of these ADRs, some of the more popular ones, have an active market over here. This is not one of them. So this is already priced in. It's trading up. I would just say if you want to just look at it technically, 215. I mean, that's where you topped out in May. That's where you topped out in March. That's where you topped out in June. Maybe that's where you top out here again. But I don't really like trading ADRs because I'm not trading the primary market.
All right, one more real quick. AMD thoughts.
You know what? This was one I had it, on in my long-term investment portfolio. I sold it when I had the big pop from $10 to 14. I thought, this is going to get overdone. Continues to get overdone. This is setting up. Cup and handle. Classic cup and handle. It's looking good. This looks like it's going to break out here again. So, Knight, thanks for bringing this up. I might put this on for a trade, actually. I'm a buyer of pullbacks in AMD here. It looking like if it can get above the high 1734, even above 17, let's just call it $17. You kissed it 2 days ago. Get above 17, you're off to the races here again. I like AMD as a trade here right now. So I would say, though, if I'm setting it up, I would not want to own it below 16. So if I'm buying here this morning at 16.89, I'm giving it 90 cents. If I'm setting up the 2-to-1 risk reward, I kind of need to make $2. So, Jeremy Newsom does a great job setting these up on his trades all the time too. This is just one of those setups there. It's fairly clean. I mean, at below $16, I probably don't want to be long it. Above 17, I do. So this breaks out over 17. I think it could hit 18.
Don't thank me. Thank Hey, it's Mellock in the YouTube chat because they were pounding the table on that this morning. So hope we got hope we got your questions answered. If not, you can join us tomorrow. We'll be right back with you at 8.
Good point though. It does report July 25th. So that is coming up in a week. So, and you know what? I like buying stocks ahead of the report. So I like it even more. I'd probably sell it ahead of the report.
All righty. Well, you can tell us about that trade on tomorrow's show. Thanks to our guest today, Chris Versace. Thanks to all of you in our chats. Hope you have a good rest of your day. Good luck out there. And we'll see you folks on Thursday.